Welcome to your market brief for the week of March 9th. Investors are facing another challenging week amid ongoing coronavirus fears and an oil price war. As Treasury yields and equity markets plummet in tandem, let's get some perspective from Gabriela Santos, global market strategist with JP Morgan Asset Management. Gabriela, thanks so much for joining us.
Thank you so much.
What could be a crazy day. Futures are tumbling. What do you make of this current landscape and some of the monumental moves we've been seeing?
When we see a week like last week, when we had big down days followed by big up days without any sort of clear direction, what it says to me is there's very little visibility right now. Very little visibility in the sense of how the new cases of coronavirus develop, what countermeasures governments take to contain the virus, which could impact activity. And number three, any sort of policy responses to soften the blow of the economic impact. So those are three big things that we don't quite know how they're going to evolve. So to us, it signals that we might still have a pair of weeks here where we continue to see some of this price action. Big down days, big up days without a clear trend. Very little visibility.
So how are you positioning yourself amid this lack of visibility? Are you looking at some of these down days as buying opportunities, especially with the dip in oil prices?
So I think, we have to think about two things. The first is what might be a difficult set of few weeks for the market as well as the economy. I think we need to be positioned a little bit more cautiously with some protection for the short term. And then we have to think about the year after, the year of the virus, 2020. So we have to think about, for long-term investors also being positioned in growth assets. So still thinking about exposure to technology, thinking about exposure to emerging Asia, for example, the long-term growth themes. And so if you're thinking about maybe I don't have enough of that exposure to the growth themes, maybe you take the opportunity to slowly add those during the next few weeks.
So are you buying some of these companies on sale then?
So I think it's not about, pulling up the truck and buying everything all at once. It's very slowly as you see some quality names sell off more and more. Maybe it's an opportunity to add, depending on where you're starting from.
What's the safety play here? Obviously, we've seen yields at record lows. Is it the bond market? Is it gold? What's the safe haven?
So the bond market is clearly acting very much as a safe haven. And I think it's interesting because we came into the year with very low yields, but this episode has shown that when there is a risk-off moment, there is no floor to how low yields can fall for treasuries. So we still believe treasuries are a very good protection play, despite the fact that it's quite expensive insurance right now. It still works in case we need it. So that's one very important protection point, treasuries.
I want to ask because we've heard some analysts come out and forecast zero earnings growth for U.S. companies in 2020 because of the coronavirus. What's your take on that? Is there any chance of a stock market rebound if we don't have earnings growth? Obviously, it was a missing component last year, but could we have another year of little earnings growth?
So for coming into this year, consensus was expecting about 10% earnings growth for 2020. We always felt that was a bit high and would get revised down, as it normally does throughout the year. So we were expecting earnings growth closer to 5%. I think everyone's still trying to figure out the actual dollar impact of coronavirus and the impact it's having on activity, as well as now the fall in energy prices. Reasonable estimates suggest that it could shave off between $4 to $6 off of 2020 earnings, which could bring that 5% growth number closer to zero or perhaps even below that.
You mentioned the fall in energy prices. What do you make of that? I mean, what are the implications for especially oil companies amidst what could be, we're hearing forecasts of $20 a barrel for oil. I mean, could these companies eventually need a bailout?
So that was a bit of an unexpected development late Friday and over the weekend. This idea that the market, really the energy market, had been looking for OPEC plus cuts, extension of the cuts they had already agreed to, plus additional cuts to combat the drop in demand during the first half of the year, and we simply did not get that. We really saw the OPEC plus alliance fall apart, and really Saudi Arabia already taking initial steps to increase production. So the oil market is faced with a shock to demand as well as no agreement on supply. So oil prices in the short term could dip even further lower. It's going to depend when Saudi Arabia and Russia eventually come to an agreement. But in the short term, it is an impact for energy companies, right? And so we have to be very careful especially when thinking about energy company credit. I think that's a very important message, both for the energy price developments as well as coronavirus. It's thinking about the quality of the credits you own. That's really, really key.
All right, we have to leave it there. Gabriela, thanks so much for joining us.
Thank you so much for having me.
Here. Shifting to a preview of the week ahead on the campaign trail, primaries will be held across Idaho, Michigan, Mississippi, Missouri, and Washington State. Major companies reporting earnings include Dollar General, Gap, Oracle, and Slack. Of course, as more and more companies confront virus-related concerns, we'll see if a rise in working remotely translates to gains for Slack's bottom line. Plus, on the economic calendar, we'll get data on the strength of small businesses in the U.S., as well as February's CPI and PPI. Plus, the ECB announces a rate decision on Thursday. Staying on central banks, I'm joined by JJ Kinahan, Chief Market Strategist and Managing Director with TD Ameritrade. JJ, great to have you back with us. All right, so let's start with the Fed. Walk us through your expectations for what you're expecting from the Fed ahead of next week's meeting and into April. Will we see another cut?
Well, if you look at probabilities, they would certainly say that you're going to, and it's almost like the Fed's been forced into this situation, right? And there seems to be a big element in the market that just wants us to zero rates no matter what. And you look at the probabilities, it's better than over 65% last I looked here, where we're going to see 75 basis points over the next month and a half, which would put us at zero. And so it's, and what we just had last week, I think, as many said at the time, cutting rates isn't going to be an inoculation. And so the only thing you can hope on this is that by the mid to late summer, because as we know, rate cuts or rate rises usually take 4 to 6 months to work through the system. And so what you really hope for is that through warmer weather or through an inoculation or something else, the coronavirus is mitigated. And if these do hit the system 4 to 6 months out, it could be an amazing second half of the year. But that's a lot of conjecture at this point. And again, my whole life I've always looked at the probabilities. The probabilities tell me it's going to happen, and I kind of have to go along with that.
Well, the rate cuts clearly right now aren't giving a boost to the market as they did last year. But in terms of the economy, what specific problems are they solving?
Well, I think right now the biggest fear for me in the economy is kind of the fear itself, as they say. And what I mean by that is you see all these conferences canceled, et cetera. Local economies are going to start feeling the pressure. And once you see that, when you see people afraid to go out and do things, that really, that quickly can take you into a recession. And so I think that that's really what they're trying to avoid right now. But, it's kind of a two-edged sword, right? Because we see all these conferences canceled, not I think necessarily that people think everyone there is going to get sick. You don't want to be the company that still holds its conference when everyone else is canceling theirs. So there's a litigation factor that's coming into play. And so I think that that's the biggest reason you've seen so many things canceled over the last few weeks.
Is the dreaded R word in your recession right now, or will that rate cut?
Hopefully not. But again, I think the next month or month and a half is going to be very key. If you look it seems to me that we're a month to 6 weeks behind what we've seen in China so far in terms of the spread of the virus, et cetera. And so if you look at, one of the things to look at is pollution readings in China. I hate to say it but last week.
The map was incredible.
The map, yeah, because people are getting back to work. We saw Apple talk about the fact that their factories are getting back to work, et cetera. So you can only hope that we are in that same sort of thing. Right now, we're still at that front end of it where they're talking about everybody working from home, et cetera.
Yeah, and hopefully that everybody going back to work doesn't reignite more outbreaks. But I do want to ask you, because last Friday we had that strong February jobs report, but the data was collected before we've really known the impact of the coronavirus. But what data points would you be tracking to kind of to get a sense of an indication of the longer term impact?
Well, I think on the employment report, the first thing that jumps out is you look at the second area that jobs were created. It was in the hospitality industry. I would certainly expect those jobs to kind of disappear this month. And the other thing being government spending, a lot of that done by local governments. That may be sort of one-time things as they get ready for some construction projects, some education projects, et cetera. So I don't think we'll see those two areas pop up on the next month. And they were number 2 and number 3 in the jobs report this time. Healthcare being number 1. Healthcare has been incredibly steady over the last 5 to 6 years. So that's number 1. The other thing I want to look at is retail sales. Obviously we know the brick and mortar companies have had a lot of issues, but I think what you have to look for is the individual companies, particularly those who are more online based. continuing to ramp up their sales, because if people are afraid of deliveries or it gets to that point, that's when you really have to be scared. And then the last one, anecdotally, I'll say, I do travel a fair amount. Restaurants have been incredibly busy. Hopefully restaurants continue to be busy, because that shows people aren't afraid to go out, get food, be in a social setting, et cetera.
Or spend money.
And most importantly, spend some money.
We have to leave it there.
Thanks,
that concludes today's Market Brief. However, we want to hear from you. Comment below and tell us if you think oil will dip below $20 a barrel, or will the price go even lower? I'm Caroline Woods. Thanks so much for watching.